Good morning from London. I'm Anna Edwards alongside Kriti Gupta. We're an hour away from the opening trade. Here's what you need to know. Traders stand by for what could be the most consequential US jobs report of the year. The Fed's Daly and Goolsbee say lower rates are coming as the labour market cools. Donald Trump vows to cut America's corporate tax rate and slash regulation as he taps Tesla CEO Elon Musk to lead a task force to audit the US government should he be elected. Plus, Europe's former Brexit negotiator Michel Barnier is named France's new Prime Minister as he bids to end the political turmoil of the past 2 months.
In the meantime, a quick check on these markets. You are seeing futures pointed decidedly lower, but again, not by a massive margin. Eurostoxx 50 futures down by 0.1%, slight underperformance in the FTSE 100, down about 0.2%. But Anna, as you say, all eyes on that payrolls number, 372 on the 2-year, ahead of that number, down about 2 basis points overnight. And as we digest the news out of France, Eurodollar at 111. We're going to dive into that. The countdown to the opening trade starts right now.
Good morning, everybody. It is Friday. Welcome to the opening trade. We're an hour away from European trade. But, of course, we've seen Asia trade a bit depleted because Hong Kong has been closed because of a typhoon warning. So the focus really of the day as we go through it will very much be on the jobs report. Yes, we have French politics to talk about as well. But looking ahead, the jobs report is the key piece of data that markets are going to be paying attention to. And, Kriti, we said in the headlines that this could be the most important jobs report of the year. And I think to myself, have we said that every jobs report this year? And I mentally check back and think, no, I don't think we did. And I'm not sure it's overplaying it because it will be something of a decider, perhaps, as to how much of a cut we get from the Fed in September. That seems to be the way the market is thinking about this.
Right. 25 or 50 seems to be the question. And the consensus around 50 is growing simply because not just ahead of the payrolls number, but also because we've gotten a deluge of jobs data this week, and none of it has particularly been positive. It feels like the slowdown is almost accelerating. We talked about the whisper number, though, 152,000. The survey estimate is 162. This is decidedly lower than the estimates we've seen in the past.
It is lower, but it's interesting that you can tell two different stories here. You can talk about the US heading for a recession, the deterioration in the labour market, and provide the evidence of this week, as you say, Kriti. Or you can say, yes, we're seeing some loosening of the labour market. You maybe even call it normalisation, given how tight the labour market has been of late, and say, look, this is still fitting with a soft landing scenario. And I see both of those arguments coming through from today's guests and the wider market commentary.
Yes, and I think that's a fair point because it's also being priced in, and you make that key point of normalization. And I think in the markets you can see that show up and say the 2-10s curve, for example, which is I keep messing up this kind of phrasing here, which is disinverting is the way to say it, I believe. But basically it's normalizing in terms of some of the way the markets are expecting the economy to react, and by extension the bond market. And I think that's crucial. But again, not everyone's going to view it that way, to your point, and not everyone's going to welcome that normalization.
Yes, it will be interesting if we get a low number on non-farm payrolls, but we see the unemployment rate come down. You know, how is the market going to interpret that? That does seem to be what the market is expecting. Let's move on to some politics. We talked in our headlines about former President Trump wants another term. He's been talking about his economic agenda. He gave a speech yesterday in front of plenty of hedge fund managers, billionaires and others at the Economic Club of New York, Wall Street, essentially. But he is putting a focus on corporation tax and saying he wants to bring it down. It's at 21%, down to 15% for some companies. He said this is for companies that manufacture in the US. So I wonder, therefore, how wide that goes. But anyway, let's assume it's 15% for now. That is certainly the headline number he's giving. It's way away from where Harris is planning to take us, which is up to 28%. This is a real dividing line.
It's a real dividing line, but you can see how he's leaning in towards basically one of the key successes of his term. Those Trump taxes of 2017, they expire in 2025. And this is something that has been a unanimous consensus from the likes of Jamie Dimon at JP Morgan all the way to your average American who's seeing, as a result of those tax cuts, more money in their wallets. And that is a function of the tax cuts. But the problem here is how do you fund it? And that's where he's saying tariffs come in handy. We're going to lessen the burden on the U.S. and then issue more on the rest of the world.
Yes, really interesting that he also is talking about Elon Musk being willing and wanting to run this sort of audit the government department, which he would like to introduce. And talking of appointees to political positions, we should talk about France.
We should. Okay, so we finally have a result. It's Michel Barnier. We are going, our colleague Stephen Carroll on Bloomberg Radio made the point, we've now gone from the youngest prime minister in French history to what's now going to be the oldest prime minister in French history. But this this is a really big deal because, of course, he's most recently known as a chief Brexit negotiator in the EU. And as we know, French politics have been very divided, especially when it comes to things like the budget and the deficit. Perhaps his diplomacy can come in handy.
Yeah, absolutely. Michel Barnier reaching out, it seems, then, not mentioning her name, but in terms of the topics he's talking about, reaching out a little to the right, to Le Pen, to the far right. He himself comes from the centre right. He is talking about including migration and security in his areas of focus, and that'll be something that the RN wants to hear about. Interestingly, they have not ruled him out, of course. They have said they will judge him on his policies, which already sounds as if he's managed to bring a few voices together. How the markets responded, though, was interesting. There was some spread narrowing, but it was only a little bit. And I know we've got a guest coming up later on today who will say, later on this morning, who will caution us that some of the market impact will be short-lived.
Yeah, and I think that reaction was less of the candidate and more of, OK, well, what is the candidate going to do now, specifically when it comes to the deficit? One of the key pieces of why Michel Barnier was actually brought in as well is because Marine Le Pen has already said she's not going to vote against him in Parliament. That is a really big deal. He's also said he's not going to be running again for president the way he did back in 2021. And to your point on policy, he's very outspoken on immigration, which seems to be a theme on both sides of the Atlantic. OK,
let's tell you what is coming up on the show today. Shortly, we're going to be speaking to Talib Sheikh, portfolio manager at Fidelity International. At 7:30, we'll be joined by Matthias Debo from Goldman Sachs Private Wealth Management. For the opening trade at 8, we'll be speaking to Bilal Hafiz, Macro Hive CEO and head of research. And at 8:30, we have Marie Jacot, CEO of Edmond de Rothschild Asset Management in France. And it's her who has cautioned in her notes ahead of the conversation that we don't necessarily assume that the short-lived market reaction, well, the market reaction we've seen will last for very long. So we'll certainly get to that. Lots to talk about in terms of the negotiations with Brussels, and all of that will be certainly in focus.
It certainly will, and we're going to be seeing a little bit of data come through throughout the rest of the day as well. 10 a.m. UK time, Euro area GDP is going to be hitting the wire. We're going to be talking about those growth stories. But Anna, as we've been saying, the focus is really in the lead up to that payrolls data today over in the States. 1:30 p.m. UK time is when that hits. And then we're going to hear a little bit of Fed speak as well. John Williams and Christopher Waller will be speaking. Remember, we're getting closer and closer to their blackout period as well. So we'll see how close to consensus they are in terms of that 25 cut or 50 or even still a hold. There are still folks who are vouching for that. But then for me, Anna, the big one is the S&P 500 details around rebalancing. Now, I should be clear, this is not a rebalancing of the index yet. This is what a very skilled producer, Badan Curtis, told me is called a pro forma file, which is basically them telling us what the weightings are going to look like in the rebalancing. This usually comes the third Friday of September. This time is coming 2 weeks early. But we're going to get insight on the weightings of NVIDIA and Apple, specifically around Warren Buffett's kind of dumping of Apple stock and how that changes the entire index.
Yeah, there are times when maybe that would be too much information, but when you're talking about NVIDIA, I'm not sure it is. This is a stock of such immense influence. Yes, and payrolls will be in focus. I'm excited to talk to Bilal Hafiz at 8, who comes with, some real granular expectations about the asymmetric reaction that we might see in markets to different types of surprises on payrolls. And he is very much talking about asymmetric moves in dollar-yen, which is sort of lodged in my mind as the topic of the week because of the way that lots of colleagues have been talking to us about how the market is underpricing the risk of a rate hike in Japan. And if we get weak data that falls into that environment, what does that do to the rate expectations, rate differentials, and therefore to dollar-yen?
And as you speak, 142 handle on dollar-yen already strengthened the Japanese,
it's a big move,
Japanese currency. It actually certainly is. And again, how much of that is pricing in exactly the concept you're talking about? As we monitor that, let's get you what else you need to note this morning. U.S. Secretary of State Blinken says the U.S., Qatar, and Egypt will present a new ceasefire proposal to Israel and Hamas in the coming days. The top U.S. diplomat says 90% of the deal has been agreed to, with the remaining issue being control over the Philadelphia corridor. Now, the comments come after Israeli Prime Minister Benjamin Netanyahu downplayed the prospect of reaching an agreement soon, blaming Hamas for stalling the talks. In the first public comment since his arrest, the Telegram CEO acknowledged that the company's rapid growth to 950 million users resulted in, quote, growing pains that made it easier for criminals to abuse the platform. The social media billionaire was charged in France last week for failing to stop the spread of illicit content on the app. And the Biden administration is planning to target China with new quantum and chip-related export curbs as it seeks to align controls by other allies as well. Now, advanced chip-making tools will be among the technologies hit by some of the restrictions. That kind of umbrella over what can or cannot be exported getting bigger and bigger over in the States.
Yeah, absolutely. This is really interesting because this is about some really high-tech stuff, quantum computing, cutting-edge technologies, but it comes after we saw 2022 attempts and ongoing attempts to get allies to be on board with the United States in limiting the amount of technology that can be exported for chip-related activity to China. It comes alongside then previous attempts around AI components, semiconductor tools. And what I find interesting here is it seems to be a little bit more carrot than stick for global allies, saying to the rest of the world, you know, we're going to have a global ban, but if you collaborate with us and do something similar with China, then you can be exempted from that global ban, which is designed, at least, to appeal to Tokyo and The Hague.
Well, bringing that right back to the government in Netherlands, which I think is such a great case study around this. And, of course, ASML being the big heavyweight here in the stock 600, 30% of their revenue comes just from the United States. Another 20%, or just shy of 20%, comes from China. So they're really getting a kind of a dose of both sides, really being kind of stuck between both governments, not to mention dealing with a labor issue of their own when it comes to immigration on the Dutch front. And I bring this all together because these are the themes that are circulating around the world, and ASML kind of has to digest them all.
Yeah, chip politics certainly seems to be something we are fully immersed in. And it's interesting because, you know, the US is trying to get its allies to be on the same page. But as you point out, there is a lot of reliance still on China, and they're mindful of not damaging those economic links too much. And it does seem as if US authorities are not entirely happy yet with the way that the Dutch and maybe the Japanese also are applying the rules with regards to China. So we'll watch that. We also had other sort of strands to the tech story overnight. We had Broadcom earnings. We flagged this yesterday, didn't we? A supplier to Apple. Sales looking light there, especially in the non-AI areas, though. So I'm not sure it added to the some of our understanding around AI.
Well, at the same time, a couple of other, you mentioned Qualcomm as well. Intel also talking about removing kind of their stake in Mobileye as well. And I think that the theme here, bringing it back to the kind of macro and the geopolitics, Anna, is that the chip sector is dealing with geopolitics for sure, but they're also dealing with a little bit of an issue of where the demand is coming from, given the slowdown in the economy. Outside of AI, you are seeing a slowdown in the tech demand, also paired with whether or not they can actually manufacture in the States. And that's where the Trump policy and the kind of corporate gains and et cetera all play.
Yeah, I mean, the IRA, that policy from the Biden administration has been really influential, and others, in trying to reshore some production. And we've seen a lot of talk about that of late. And we'll certainly get back to that conversation.
To the dismay of the likes of Emmanuel Macron, of course. So we'll see how this how the next 6 months shake out on the chips front.
Absolutely. A lot of politics in there, too. Now, coming up on the programme, more on the reports that Qualcomm has explored the possibility of acquiring parts of Intel's chip design business. We'll discuss that story and the latest US chip curbs on China that we were just having a conversation about there. Plus, we'll take a closer look at Trump's economic speech. He was speaking at the Economic Club of New York, in fact, and we'll preview next week's debate between former President Trump and Kamala Harris. Up next, we'll speak to Talib Sheikh, portfolio manager from Fidelity International, ahead of today's jobs report. If you have any questions for our guests, if you want to get in touch with us, please do. ID plus BBTV Go is the function to use on the Bloomberg terminal. This is Bloomberg.
My best guesstimate would be around 3%, perhaps 2.5%. It's generally beneficial. The major cost when you get a mortgage is the interest rate. So if the cost of mortgages come down, the cost of buying a home would also come down.
John Paulson, founder of Paulson & Co., Trump fan, and was in the audience at the New York Economic Club yesterday to listen to former President Trump give his speech yesterday. That's the politics. Let's focus on the jobs story that still lies ahead of us. Talib Sheikh joins us, portfolio manager at Fidelity International, with us on set this morning. Talib, very nice to have you with us. I'm interested in the story you're telling around the jobs market in the States and what that means to you, because we heard there from the Fed's Raphael Bostic saying we've gone from super hot to solid. I mean, solid doesn't sound overly worrying, does it? But for some people, there are sufficient cracks that we should be talking about a 50 basis point cut in rates. I mean, what story are you telling here?
I guess our story at Fidelity really is one of a soft landing. Clearly, we've seen a weakening of the labour market. We've seen wage growth slow. We've seen job demand slow as well. And we would see this as a natural slowing process. Clearly, we had a bit of a panic around the unemployment rate in August. We think that that probably was a blip. There are some blips in terms of the temporary numbers, and we'd expect some of that to come back this time. So we're probably in line with the consensus. We're looking for the unemployment rate to be 4.2, maybe 4.1. We're also looking for private payrolls to be at 140. When we put that together, we think that 25 looks the most likely scenario, but we clearly can't dismiss a 50 basis point move here.
Yeah, it's interesting because the other things that you said there make it hard to justify 50, and I know that's not your base case. And I wonder how so many people are talking about 50. I mean, the market's pricing in 35, I think, which is not a number the Fed usually does. But, yeah, what is the thinking around 50?
I think what has been clear is that there's been a change of mindset from the Fed post the Jackson Hole conference, and they've really moved to more of a risk management framework. The bar for them to do 50 is much, much lower than it was historically. Clearly, there's two sides of the ledger that they're looking for. The first side is inflation, and that looks to be moving in the right direction. There are still elements that are sticky, but not too worrisome. And the other side of the ledger is growth. And as we say, we're in the soft landing camp, but clearly we're seeing growth moving to trend and probably below. So it means that actually that risk management framework becomes much, much more important.
So the survey number here is 162. This is substantially lower than we've seen post-pandemic in terms of the estimates. So you are seeing some element of normalization, to your point. But it's still pretty high from a historical basis. I'm curious, given that information, how do you trade it?
Well, I mean, we are going to go in relatively neutral. I think it's a coin flip at these levels. Certainly when we look at our asset allocation as we move through Q4, I would say that we're light compared to where we have been for the previous year or so. So we're really looking for opportunities to add risk to the market, really reflecting our soft landing kind of narrative. In terms of fixed income, I'll be honest, I think we've been surprised at the rally of fixed income, particularly that we've seen over the last 6 weeks or so. So an awful lot of that Fed easing narrative is already in the price. As you say, we're priced 50-50 for 50 basis points today. We're priced for 100 basis points by the end of the year. So a lot of that easing story around financial conditions is already in the price, and we're seeing it on the dollar, particularly this morning.
Is a 50 a basis point cut in the price?
Well, I think, it doesn't really matter what they do today, whether it's 25 or 50. I think the market will just slew that year-end pricing. We'll move to the summary of economic projections in September, and we'll have a much clearer guide on where they're going to go. But, whether they do 75 basis points or 100 basis points this year, I think it's relatively immaterial from a risk asset point of view.
Yeah, can I ask you about politics, Talib? And just from a market's perspective, what are you assuming when it comes to the candidates as we build a bit of a picture as to what they would mean? We heard from former President Trump just yesterday and what he plans to do with corporation tax, for example. I saw a survey by Nomura that was asking, what would Trump mean for the economy? And that survey suggested that investors think he'll mean higher inflation and a higher deficit, but also higher GDP. Do you think that's the way that financial markets are approaching this election?
I think so. I think, we've seen a steepening of yield curves across the globe. We would argue that that continues. We would argue that that's likely to be a bull steepening as the Fed continues to cut. I'd also argue that both candidates really have a kind of America First exceptionalism really at the core of their economic policy. We saw that with the CHIPS Act, we've seen that with the IRA Act, and we think that that probably continues. So net-net, it means that we're still reasonably constructive on the US economy as we look through into 2025. Does that create inflationary problems further down the line with the deficit, as you talk about? They can't be dismissed, but I think they are probably further out than most of our kind of investable time horizon.
Yeah, so in that sense, is it too early to make calls around US politics? I
think so. I think we're looking at best, a change in fiscal policy. Really, we're looking at the second half of 2025, and clearly a year out from that, it's quite difficult for us to do. We're just trying to really pass through what those policies look like, how they're going to position for them, but it's too early at the moment to really make a big call on that.
When we talk about just kind of this question of how we interpret jobs and then marry it almost with the politics, how are you thinking about immigration, given that so much of these numbers are a function of a pretty massive migrant population that has been in part fueling the economy? Walk us through how you price that, though, from a political standpoint, but also from this kind of normalization you're seeing in the data.
Clearly, we need to take an average of the jobs numbers. Obviously, yesterday we saw reasonable numbers coming from the PMIs and the ISM. We saw less reasonable numbers coming from the JOLTS data. I think we're saying that actually post the pandemic, we're in a very different jobs market. Immigration that you talk about, undocumented workers, the difference between the two surveys. Really what we're trying to do is look through that, take an average and get a general trend of where the jobs data is going. And really that leads us, as I touched on earlier on, to that soft landing camp. Not too hot, not too cold. I think it's way too early when we look at the data to kind of ring the bell on the recessionary dynamic.
So then you made a crucial point earlier, which is that the bond rally surprised you in some extent. You may also made the point that the markets are kind of pricing in these cuts already. I'm looking at 370 on the 10-year yield. How low can these yields go by year end?
Well, I would have told you that 4 probably was the bottom if you'd have asked me a few weeks ago. So I think we are getting to the level where we can't go much further. We've got the terminal rate down at 3. Again, you really need to see a recession starting to come into play on that kind of dynamic before you can really start to break down below 370. So yeah, I think we're probably as far as we can go until that recessionary dynamic gets priced into markets. And we're not really seeing that yet.
And is that factoring in the election as well, or the election risk? And the reason I ask that is because what I haven't been able to work out just yet is if both candidates eyeing or this kind of looming deficit deadline in January, if as a function of that, the yields go higher because of the inflationary impulse, or yields go lower because of these kind of defensive fund flows from the rest of the world piling into what's still considered the safest asset in the world. And I'm curious which way that affects the bond market.
Yeah, I'm quite sceptical when people talk about risk premium in the US bond market because of the deficit. We know that those deficits are historically very, very high. We know that there will have to be some action around them. The question is, does the bond market force them into action? I'm quite sceptical about that. I think the place where you're likely to see much more weakness really is in the dollar. To some degree, you've seen that over the last 6 weeks or so. So I think that's the place really where the action will happen, and that's by and large relatively positive for risk assets.
What are you expecting to see in credit markets? You say in your notes ahead of our conversation that you're ready to increase your exposure to high-risk credit once we see a meaningful widening of credit spreads. Are we seeing something a little surprising in credit markets, that spreads aren't widening as the data on jobs deteriorates? Or do you think they're focused on the soft landing, so there's no need? Yeah,
I think there has been a disconnect in the market. The bond rally that we've talked about really is pointing to something more worrisome. If you look at the breakdown in some of the cyclical markets around the world, or the breakdown in copper, they're all pointing to much lower growth ahead. Contrast that with both high yield and investment grade spreads. You know, they remain resolutely tight, and certainly when I look at the portfolios that I look after, we are relatively light credit risk. We do think that there will be a buying opportunity going forward, but we're not ready to kind of chase the rally that we're seeing at the moment.
Talib, thank you very much. Thanks for joining us. Talib Sheikh, Portfolio Manager at Fidelity International. Lots to discuss, lots to feed into our next conversation then, Kriti. I think the guest coming up next part of the programme also expecting a soft landing for the US economy, despite cracks in labour markets. Interesting as well around the politics that it's perhaps too early to meaningfully factor in what these contenders' policies will all be about.
Well, the connective tissue between the 2 points you just made is the fiscal spending, right? And it's something that's directly applicable to right here in Europe, which is also driving out performance in certain economies. And we'll see whether or not that continues in the next 6 months or so. Coming up on the program, we're going to Matthias Debo of Goldman Sachs Private Wealth Management on why he thinks U.S. economic expansion is far more likely than recession. More on that soft landing narrative. Stick with us. This is Bloomberg.
Welcome back. 30 minutes before the opening trade here in Europe. As one of our producers rightly points out, it is Friday, but it doesn't seem like we've got much of a Friday feeling in stocks this morning. Yesterday, we saw European equity markets underperforming the US a little by the close. So maybe we have some catch-up there, you might think. But then futures don't suggest that we're going to go anywhere in a hurry this morning. Some negativity there in European futures and in US futures. So we'll certainly not expect much on the upside at the start of trade. It is jobs day, so we'll be, of course, mindful of the really important data points points, Kriti, coming a little later on in the European trading day.
We absolutely will. I mean, the doomsday continues when you look at some of the data and the potential read-through into the bond market as well, where it kind of looks like there's a bid going into the more safer assets, perhaps that precedent being set by what you're seeing over in the States as well. The 10-year, the 10-year on the German, French, and Italian debt all down by about 2 basis points this morning. So we're going to see whether or not that continues, whether or not that's just a little bit of a retracement of some of the action you saw this week. I really want to zero in on some of the numbers around Germany, though, because we did get industrial production numbers coming out this morning and a massive miss on the numbers. Now, we know this is a weaker economy. We were expecting a decline about 0.5%. Instead, we got a whopping 2.4% decline on a month-over-month basis. You can really see just how big that is on the right-hand side of your chart when you really look into the bars and whether or not just how big of a margin that is. It is one of the biggest margins going back about 3 or 4 years. In that same vein, I want to get a little bit more analysis here on how you actually think about investing, not just in Germany, but in Europe broadly. Let's bring in a true expert on the subject, Matthias Debo, Investment Strategy Group, EMEA Head at Goldman Sachs Private Wealth Management. Matthias, a pleasure to have you on the program and conveniently joining us out of Berlin this morning as well. Matthias, walk us through the thinking around some of the weakness you see in the economic data. This is not a surprise. We've had a string of weak numbers coming out of various parts of Europe, and it's been a conversation that's been happening, I'm going to say, for the better part of 2 to 3 years, is underperformance in Europe. How are you thinking about it? Is it an opportunity in your eyes?
Thanks for having me. Yes, certainly we are seeing a lot of signs of weakness out of the industrial sector, most notably in Germany. So we, in fact, expect the German economy to not grow at all over the course of 2024, mostly because of the struggles in the manufacturing sector. Spain should do better, and Italy and France should be somewhere in the middle, so that in aggregate, the euro area as a whole should grow at around 0.7%, according to our forecasts, which is slightly below trend and nothing to really write home about. But what we're seeing is sort of this K-shaped recovery between the manufacturing sector, which again is struggling, and services, which are holding up much better than expected, if only because of tourism, which is doing really well.
Well, walk us through that dynamic as well, though, because at tourism, so much of it is also driven by excess savings, excess stimulus in various other parts of the world, including and largely driven by the United States. How much of that is a function of fiscal spend, though, and how long does that last, especially in some of the economies you mentioned?
So most of the excess savings that we had seen around the world that had been built up have, to a large extent, already been spent according to our estimates. What we're seeing now, though, is that with the decline in inflation and tight labor markets pretty much across the board, real disposable incomes are actually rising. People have jobs, their wages are rising, and inflation is coming down. So that means that the consumer has more power to spend, and we expect them to continue to do so. So that is one of the reasons why we expect some acceleration over the next few quarters as interest rates come down and real disposable income remains quite solid.
So you don't seem overly worried about the consumer picture, Matthias, broadly. Tie that to the struggles, back to Germany, tie that to the struggles that we're seeing in the auto sector. Are there reasons, do you see the auto sector as something to invest in at this point? Valuations might suggest so, but so many headwinds and competitive threats facing this sector right now.
Absolutely. That is not a recommendation that we currently have for our clients. The auto sector is without a doubt very cheap, but perhaps for good reason, given the structural headwinds facing the sector, the lack of competitiveness, which is really weighing on the sector. So as a result, we don't see a clear catalyst that could unlock the value that currently exists in that sector. We do see value elsewhere in the European equity market, specifically defense companies and utilities companies look attractive to us, but for now, not the auto sector still.
OK, and thinking about the US, Matthias, we've been discussing a number of times already this morning the jobs report due out later on today, and a lot of people, of course, joining the dots between that and what the Fed does in September. I think the market is pricing in 35 basis points of cuts from the Fed this month. And once again, we get to this conversation, will it be 25, will it be 50? Does the data look as if it only justifies 25 to you?
So our expectation is that we're going to get 325 basis points of rate cuts in each of the next 3 FOMC meetings, given that we've seen progress on inflation, the labor market is clearly cooling, and the policy rate is clearly well above neutral. So as a result, we do see a strong case for the Fed to start cutting. Now, whether it's 25 or 50 basis points will really ultimately depend on the health of the labor market. So we really need to watch the unemployment rate numbers that we're going to get later today, because they will dictate how fast the Fed will start cutting interest rates. So again, our base case is 25 basis points, but we don't rule out a 50 basis point rate cut.
Matthias, how does that affect your asset allocation that you recommend to clients when it comes to investing in the public markets versus the private ones? Do these rate cuts incentivize hopping in at what's largely expected to be higher valuations in the stock markets, arguably the bond markets as well?
So our recommendation remains that our clients stay invested in both equities and bonds at this time. When we look at the equity market, what we are seeing is that we see a U.S. economy that is still growing, slower than it was before, but still growing nonetheless. We assign only 30% odds to a U.S. recession over the next 12 months. So our strong base case is that U.S. economic growth will remain positive. And at the same time, we expect the Fed to start cutting interest rates in 2 weeks' time. And historically, that combination of a Fed easing monetary policy and an economy that was growing has been very favorable for stocks. In fact, the S&P 500 rose on average 19% in the year after the first Fed rate cut historically, as long as the U.S. economy did not fall into a recession. So for that reason, we still think equities are attractive. And when it comes to bonds, we think they continue to play a very important role in our clients' portfolios. Not only do they generate income with today's higher yields, as well as diversification benefits for portfolios, but they're also a great hedge against equity market downdrafts. So whenever we see some wobbles in the equity market, your bonds can act as that important hedge in your portfolio.
And Matthias, talk to us about those wobbles. We certainly saw one around this time last month, didn't we, attached to the jobs report and also moves out of the Bank of Japan. But you make the point in notes ahead of this chat that pullbacks of approximately 5 to 10% are actually pretty normal. And so are you using those pullbacks then as opportunities to increase exposure to equities?
Absolutely. In our view, periodic pullbacks in the equity market are frankly inevitable and just part of normal equity market volatility. So they're not a good reason for you not to be invested in equities. Now, what we tell our clients is for those clients who are still uninvested in equities or not fully invested, they should use those 5 to 10% pullbacks as an opportunity to accelerate the capital deployment into the market. But for those clients who are fully invested, again, this is just normal equity market volatility in our view and not a good reason not to be fully invested at this time.
So that's the approach when it comes to pullbacks in equity markets. If you talk geographies then, Matthias, you've talked about US stocks and staying invested in US equities. Where in the world that we don't talk about very often or haven't talked about in this conversation yet are you also interested in equities?
So we do see some opportunities, like I said. So our key recommendation to our clients is to actually have a structural overweight to U.S. equities in their portfolios, because we do think that the U.S. equity market, for many structural reasons, is the most interesting equity market out there. But from a more tactical short-term perspective, there are definitely interesting opportunities elsewhere as well. I mentioned earlier European defense and European utilities as examples. We have a small overweight to Japanese equities, for instance. So there are other opportunities elsewhere, but the structural recommendation remains to have that large overweight to U.S. equities in client portfolios.
Is that a play on tech specifically, though, or is that a play just on corporate margins, liquidity? What are you responding to outside of U.S. economic health?
So we've had this theme of U.S. preeminence for the last several years, where we believe that, again, U.S. equities, due to structural reasons, should continue to do better than the rest of the world. It doesn't mean that U.S. equities will perform every month, every quarter, or even every year, but over the longer term, which is what we tell our clients to focus on, we do see scope for U.S. equities to continue to outperform. And that is due to the diversity of the U.S. economy, its innovative and productive private sector, its wealth of natural resources, sources, its favorable geographical position, its favorable demographics, and so on. So there are many factors that should continue to support the U.S. equity market over the medium to long run, in our view. And for that reason, we remain very comfortable maintaining that overweight to U.S. equities.
Speaking of, let's talk a little bit about kind of the issuance perspective as well. And I think it's really handy that you're starting to see this massive move in the equity market. And yet, more people are still a little hesitant when it comes to the credit markets. I'm curious when the credit markets perhaps catch up to the outperformance you're seeing in equities.
Yeah, so right now we have a neutral allocation to credit in our clients' portfolios. We do have a structural, strategic allocation to credit, but from a tactical perspective, we're neutral, mostly because spreads look a bit tight to us against the backdrop of an economy that is still growing, but clearly slowing. And we don't think that you as an investor are necessarily getting handsomely rewarded for taking on the bigger risk that you have in credit. So as a result, we have a neutral recommendation right now, but it's definitely an asset class that we continue to look at very closely.
All right, Matthias Debo, we'll leave the conversation there. Goldman Sachs Private Wealth Management joining us from Berlin this morning. We thank you so much. Coming up on the program, luxury company Puig out with their latest results. We're going to take a closer look in our stocks to watch next. Stick with us. This is Bloomberg.
Welcome back to the opening trade. We still have around 15 minutes to go until the start of equities trading here in Europe, and the futures picture looks negative. We could see losses around 0.3% this morning. US futures also finding reasons to head lower. E-minis down by 0.25%. Nasdaq futures even more so. So, Kriti, we're set up for something a little negative as we wait for the jobs report. That's going to be the big talking point of the day, the big data point of the day, and it still feels as if maybe markets have a little bit of PTSD attached to some of the data we've seen out of the US in recent months. Certainly this week around the labour market, but of course I'm thinking about the jobs report last month. I mean, that was really weak, and that really spooked investors. Came at a time of real sensitivity for markets combined with the BOJ commentary and rate moves. So, we are holding on tight.
Well, it's the payrolls number, and then I feel like the drumroll to the payrolls number hasn't been a particularly strong one either, right? We have weak ISM manufacturing, weak JOLTS, weak initial jobless claims, weak ADP, and then we're getting the payrolls number. Yeah. Not to mention a beige book that was very doom and gloom. I'm curious about the trade around this, given that the estimates are significantly lower than they have been. 162,000 on the survey, 152 on the whisper number. Is this a moment where economic surprises are maybe to the downside or a positive for the markets?
Let's get another view, shall we? Executive Editor for Asia Markets, Paul Dobson, joins us to talk about the markets in 3 minutes. Paul, good morning to you. Let's start then with the jobs report and how the market is set up to receive this jobs report, given the tensions we saw at the beginning of August, and our memories go back there, perhaps.
Yeah, good morning, Anna. Absolutely. So the market is looking, as Kriti was describing, for a number that's better than last month's pretty dismal numbers. But the risk that the market is pricing in is all skewed to the downside, to a lower number, to a weaker dollar as a result. You can see that in the FX markets in the options space, for example, where there's elevated levels of overnight volatility being priced in, and the skew very negative for the dollar. So people are expecting that if there is a surprise, most likely it will be to the downside. It will push down those shorter dated yields on US Treasuries, and it will drag down the dollar against all of its major counterparts, from the euro and the pound in your region to the Asian currencies as well over here.
How much lower can it get, Paul, and to whose benefit? And the reason I say that is because as we speak, I'm looking at my screen here, you're seeing already a 3 to 4 basis point move in the front end of the Treasury curve. The payrolls number hasn't even hit yet. U.S. traders aren't even awake yet, not to mention dollar weakness. And I'm curious what the other side of that trade is. If we're talking about dollar weakness, those yields pushing lower, what currency benefits?
Yeah, well, I don't know if you would call it a benefit necessarily, Kriti, but the balance of risk there is particularly on dollar yen. We have some commentary out there from UBS today saying if the unemployment rate gets up to 4.4%, then dollar yen could be in deep trouble, meaning it could push beyond those levels that we saw when we had all the market turbulence this time last month. continuing further strength for the yen. That in turn is not good news for global markets, given that a lot of the carry trades that we saw were laid on the premise that the yen was going to be weak and stay weak. It's also not good news for Japanese equities because a stronger yen would destroy some of the earnings power from exporters. So that's really one of the areas of focus across the FX market. And then, like you said, people looking at the short-term interest rates and where that could go and how much further that could go. The benefit there being, of course, if you're a bondholder and you're looking for some appreciation in the price of the bonds that you're holding. I think for stocks market, jury's out a little bit, but too much bad data like we've been seeing this week, and the market starts to think, uh-oh, headed for a recession. And again, that can be a negative there too.
OK, so a little bit of bad can be good news for stocks, but really bad can be bad news for stocks. So we'll park that one and see where we end up. That's a look at some of the data points. We're data dependent, aren't we, Paul? So do we listen to the Fed commentary still? I'm sure we do. What stood out for you?
I think really interesting. So we heard from Mary Daly overnight, pretty much repeating the Powell view that he gave us in Jackson Hole, that the time to start cutting is soon, and that the Fed does not want to see any more deterioration in the labour market. So that does put the focus on the jobs. But also we're seeing the Fed policymakers start to talk a little bit more about the pace of cuts from here, about continuing scale of cuts. And that's putting people's minds back onto what the terminal rate looks like and how low we could get over time. Is 3% where we end up, or could we really get all the way back down to where we were during most of the last decade with yields much lower? That's what people are paying attention to at the long end of the yield curve.
Paul, thanks very much. Bloomberg's executive editor for Asia Markets, Paul Dobson. Thank you for joining us. Remember, you can get analysis from the Markets Live team. If you'd like to follow along, of course, with their thinking around the jobs report, that's all available to you. MLIV Go is the function to use on the Bloomberg terminal. We get data monthly around France and its industrial output falling 2.2%, I think, just now hitting the Bloomberg terminal. And the month-on-month number down by 0.5%, the estimate 0.3% lower, so not much to write home about there. But, Kriti, you've got some other corporate stories in focus.
We do, and I should mention that France industrial and manufacturing numbers come off the week of some pretty weak German numbers as well. So the core, again, not doing its Pilates, as we made that joke yesterday. In terms of the corporate space, there is one that we want to keep an eye on. I'm obsessed with this deal, as we know. BBVA saying that the Sabadell takeover bid that they have has received approval from the ECB. Remember, they had also gotten regulatory approval in the UK when it comes to their UK business as well that Sabadell actually has. So it looks like this is still a deal that's very much going ahead. The timing is largely expected by the end of the year. But remember, this is something that even the company says isn't a hostile takeover. The market may actually disagree. And now that has that approval may move the markets at the open. Let's talk about some of the other stocks that may be moving at the open. Lizzie Burden, what are you watching?
Well, Kriti, let's start off with earnings. Puig out of Spain. Maybe you haven't heard of Puig, but you will have heard of the brands that it owns, the likes of Carolina Herrera, Nina Ricci, Jean-Paul Gaultier and Charlotte Tilbury as well. It listed in May. It joined the Spanish IBEX over the summer, and its exposure to the fragrance market really helping it to distinguish it from rivals. So you've seen higher sales in the first half. We keep an eye on that. We also are watching Barclay Group. It reported results this morning. Pretty stable, a full-year pre-tax profit forecast meeting estimates, and it comes alongside the Halifax data that we got, so feeding in the macro picture as well. Not much of a change in outlook for the year. House prices rising slightly in August thanks to the Bank of England cutting rates, and interestingly that contrasts with the decline that we saw in the nationwide data. So we'll watch the home builders as a whole at the open as well. Turning next to the chip stocks, to the French stocks, because markets really are watching the political gymnastics out of Paris. Yes, we now have Michel Barnier as Prime Minister. Yes, there'll be relief that potentially a new government could finally be formed, but we haven't heard much from Barnier since Brexit, so we don't know exactly what sort of domestic compromises he'll be willing to make. He's been talking to the far right. We had the CAC closing down yesterday for a third straight day, so it'll be worth once again keeping an eye on the likes of BNP Paribas, SocGen and Crédit Agricole. Finally, turning to the chip stocks, because we had Broadcom's results yesterday. It fell in late trading despite, because of the disappointing sales forecast. That was interestingly tied to the part of the business that is not related to artificial intelligence. So it'll be interesting to see how much of a read-through we get into European chip stocks like ASML, like STMicro, and like Infineon. But that's what I'm watching this morning.
Yes, some pretty big year-to-date moves in some of those European names around the chip industry. Lizzie, thank you very much. Bloomberg's Lizzie Burden with some of the sectors and stocks in focus. Kriti, we should have a mention of Hong Kong this morning. We should make mention of Hong Kong this morning. We have seen that trading has been scrapped. All stock trading was scrapped in Hong Kong as a typhoon nears. And whilst that might sound, it's disruptive if you live there, for sure, it might not sound like something we need to mention. But it is interesting because it marks the last time, probably, that this will happen, because they're getting away from shutting markets in this way from September 23rd. They won't be doing this anymore.
But what a day to do that, especially when we're talking about the payrolls report. We're talking about this international positioning around it. This has been the talk of the town, the talk of the world, if I can go on and say that. So this is incredibly inconvenient from a positioning standpoint. But I am curious what that means. We actually have live pictures, as we see on our screen.
That looks ominous.
Of that. It certainly does. I was going to say it's not a picture of London, but it's not. but I think this is important as well in terms of maybe the light liquidity and light volume we're seeing.
Yeah, I don't want to make light of what's happening in Hong Kong, because obviously that could be damaging and worrying for people. But, the London weather also didn't look worth getting up for this morning, I would say. So it is Friday. We're working our way towards the jobs report. Kriti, that is going to be the focus. We're going to have a conversation with Bilal Hafiz from Macro Hive shortly. He'll give us some real sense of how we're going to trade this. We were hearing about some of the asymmetric expectations around dollar-yen from Paul Dobson, and Bilal seems to have some similar expectations around how payrolls will be traded, what the markets are actually looking for.
We keep talking about this trade of whether or not the carry trade unwind still has some unwinding to go, and whether or not this repatriation flows are going to kick in at some point, all ahead of the U.S. election. So this is a capital flow story as much as it is a fundamental story as well. And I think that's a really crucial one that we're going to, of course, pick Bilal's mind. Also, the fact that the Federal Reserve is now talking about 25 or 50, and now we're actually potentially seeing a even more hawkish BOJ.
Right, yeah, absolutely. So again, it'll be that interest rate differential, dollar-yen expressing that. We see substantial move in dollar-yen this morning. The yen up by 0.7% as we head towards that payroll number. We haven't even seen it yet. We will brace for some response to it. The market open for Europe, though, is up next. We'll bring that to you. This is Bloomberg. Welcome back, everybody. A couple of minutes to go until the start of trading here in Europe for the final trading day of the week. Let's have a look at where we were yesterday. I'm not sure this gives us a huge amount of a story when it comes to Friday's session, simply because we've got the payrolls report to come. But we did lose steam during yesterday's session here in Europe, Kriti, and also into the United States and in the US session. September, as we know, seasonally a difficult month for equity markets, and we seem to have started out with that front of mind for equity investors globally so far this month. So negativity in yesterday's session. We're looking for some of that to continue at the start of the trading day today as we wait for the payrolls report. 160,000 or so expected jobs to be created over in the United States, but we could see that unemployment rate tick down, Kriti. So it will be interesting to see how the market digests that.
Absolutely, and the doom and gloom continues over in the futures picture that we are seeing as a really continuation from most of the action that we've seen this week. Red on the screen across the futures. Sure, your Stoxx 50 futures down 0.3%, but certainly some underperformance on the Nasdaq 100 futures, well, down 0.6%. How much of that is positioning, Anna, to your point around the payrolls number? When we look at the individual stocks to watch, though, of course, French stocks are going to be top of mind as well in terms of processing and digesting some of the news coming out of the French leadership. But we also have our eye on the chip stocks. Remember, we have the U.S. really expanding some of the export controls that they have in that sector. That is going to show up likely in ASML, some of the other chip makers in this region as well, or chip-associated stocks, I should say. BBVA and Puig, these are two Spanish companies, both in folks today after the ECB gives their approval on that Sabadell takeover from BBVA. And then Puig, of course, posting higher sales and boosting fragrance. There's a little bit of a luxury read-through in there, Anna. We'll talk about how that gets married to perhaps what we're seeing in the French stocks.
Absolutely, and you're right to remind us to keep an eye on those French stocks, because we did get time to respond to some degree to the news about Michel Barnier becoming Prime Minister yesterday. We saw banks actually moving higher on that, but they were in good company. Other bank stocks around Europe also moved higher, but we'll certainly have another day of focus on France as we wait also for that non-farm payrolls data later on today. Let's have a look at where the markets are opening up then. It's just gone 8 o'clock here in London, so we are seeing some opening trades coming through. The Stoxx 600 down by 0.2%. The FTSE 100 down by around that amount. We have a sluggish start for the CAC 40 and the Xetra DAX. No trades there just yet. And we did see some market response to the French news yesterday. There we go, the French market down by 0.1%. Yes, some support for the banking sector, perhaps one of the things you could point to. A little bit of spread narrowing, French debt over German debt yesterday. How long-lasting will that be? We'll certainly come to that in later conversations this hour. So for the moment, Kriti, on jobs day, as we wait for the jobs report, the non-farm payrolls and the unemployment rate out of the United States later on today, we see a bit of sluggishness on European stocks. What do you see from a sector perspective?
Yeah, a little bit of a waiting issue here as well. I'm going to kick it right off when we talk about the tech sector, because ASML is going to be one of your biggest weights, one of your biggest decliners that you are seeing in the index this morning. You are seeing a move of about 0.6% to the downside, right alongside Novo Nordisk, which tells you right off the bat that your healthcare sector and your tech sector are both going to be quite painful. But from a index kind of appreciation point of view, we are seeing travel and leisure outperform a little bit. The property sector as well is going to be one we keep an eye on. But banks really taking a beating. And I'm curious how much of that is a rates play, given that we're already seeing a move in the bond market this morning.
That is interesting, because some of the banks, yes, there were French ones in there, but not exclusively. Some of the banks going higher yesterday. So it seems to be a bit of a turnaround from there. There are a few banks in positive territory, but not very many. So the balance of things is tilted towards the downside. Around 3/4 of sectors do seem to be in negative territory. A bit of brightness around travel and leisure, as you point out, Kriti. But it does seem to be, well, there's a bit of travel in there. There's a lot of leisure in there. Flutter Entertainment, I can see, up by just over 1%.
When we talk about the movers, though, I mean, we're coming right back to the French read-through. We also see some outperformance in LVMH. And I say that with a big grain of salt, because the outperformance is coming only higher by 0.2%. That's not a massive margin of success when we're talking about those kind of moves. We are, however, and I'm going to bring this right back to some of the underperformers. This feels like a waiting story, because we're also seeing Shell underperform. You've had your eye on the miners in the commodity space this week, down about 0.7%. Novo Nordisk, Novartis, healthcare really on the back foot. Even Banco Santander, which I thought was interesting. We're seeing BBVA over in Spain as well, also taking a little bit of a beating this morning. Yeah, it's been a tough week for commodity prices and oil prices. They've stabilised towards the end of the week, but certainly we're still around the 70 mark on WTI, 69.55 precisely, and 73.08 on Brent. Both of those up 0.5% this morning, but down on the week. Let's talk about the broader investment picture then, as we are waiting for that jobs report. One of the most eagerly awaited US payroll reports of the year out today, said at the top of the last hour. Is that overdoing it? It does feel as if there's a lot riding on this one in terms of the extent of the cuts that we get in September from the Fed. Here are a few of our guests this week with their expectations.
Look at what the claims numbers have done in the last 6 months. They would actually be suggesting that the unemployment numbers might come down for the next couple of months. The market itself is looking for a cut, a reduction in unemployment from 4.3 to 4.2.
A miss on jobs will hurt significantly, and a beat will probably be looked more favorably. What I like to look at is where are the jobs created, what's going on with manufacturing, what's going on with transportation jobs.
If I think payrolls comes in beneath 100,000, that's my threshold, because if it becomes beneath 100,000, that would be the worst of this cycle so far. So I think that would definitely add to the deterioration signs. But, you know, if our view comes right, that it's 150,000, and that's actually a bit below the consensus, which last time I checked was 165,000, then I don't think there is a risk of a repeat. I think people will actually settle down and realise that these aren't recessionary numbers.
OK, let's get another view. Bilal Hafiz joins us, CEO and Director of Research at Macro Hive. Bilal, really nice to have you with us this Friday. Now, before we can get to the weekend, we have to get through the payrolls report, so let's do that. We were just hearing the Deutsche Bank expectations there. You know, less than 100,000, that would be bad news. But anything around the 150,000 mark, he thinks the market can live with that kind of number. What are your expectations today?
Well, great to be here, Anna. My expectation is we actually have an AI model that predicts payrolls. It's had a really good track record over the course of this year. And surprisingly, it's actually forecasting a 190 print for payrolls. So it's expecting an upside surprise. Now, of course, it won't always be right, but our model is actually leaning to the upside. So we're actually looking for, reversal of some of the moves that we're seeing today. Now, more generally, I would say that if we were to go below 160, even if it was 150 or 140, I do think the market would take that quite poorly overall. OK, yeah, it's interesting.
So you say your model is skewing to the upside here, an upside surprise. We were hearing from Paul Dobson, our colleague in Asia earlier on, that if he looks at options markets, there's a lot of negativity around the dollar, and we already see that the yen is gaining, as if the market is maybe expecting something weak on payrolls. What do you make of that kind of positioning? Because, of course, dollar-yen, there's been a lot of focus on that since the beginning of August when we saw such a lot of movement there.
Yeah, I would say there's two things there. One is that in general, if you look at the behavior of, for example, dollar-yen around payrolls reports over the last 12 months, typically it falls a lot more on a negative surprise than it goes up on a positive surprise. So the market's aware of this skew. So that's one of the reasons why the dollar-yen is behaving as it is. The question then is the market already positioned for that? And I would be cautious around that, because when we had jolts earlier this week, you could have said the same thing, yet dollar-yen fell dramatically after that. So I would still think that even though the market's already preparing for a weak number, if we were to get a weak number, I do think we'd see an outside move to the downside. So we can
still be negatively surprised, even.
Indeed,
yeah,
yes.
Okay.
What does that trade look like if we actually do see a negative number? Is that interpreted, though, as a positive or as a negative? It's very confusing to me of whether this kind of move lower in the payrolls, which historically would be right on par, if that's actually a bad thing.
It's a good question. I would say, it depends which market you're looking at. I think if we were to see a decline in payrolls and an associated rise in unemployment rate, that would have a follow-through to the rates market. The market would then price a 50 basis point cut in September. As for equities and risk markets, I think risk markets, are very sensitive to growth dynamics rather than to interest rates right now. So if we were to see a weak number, I do think risk markets such as equities would take that badly. So rather than bad news being good news, in this case, bad news would be bad news for equities.
Let's talk about this bond market here, because you talked a little bit about how the FX market and how the dollar may be shaking out, but it really feels like it's a function of this move we're seeing, specifically in the front end of the curve, right? And this narrowing between, I'm going to say the 2s, 10s, but you can see it across the curve in terms of kind of the yield premium that's offered. In the last 5 days, we've seen a 21 basis point move in the 10-year. What is that about? Is that just repricing, or is that an overreaction, or is that a flood to safety? How would you characterize that?
It's a great question. I think it feels like it's a rerun of what we saw a month ago. If you remember, before last month's payrolls, we saw a similar 20 basis point drop in the run-up to payrolls itself. And it's really back to this question of, number one, the market getting worried about a recession. So globally, data over the past week has been quite poor. Could sort of indicate that. If you look at commodity prices as well. And the other one is the market is trying to work out whether the Fed will go with a 50 in September. So the market's kind of oscillating around that all. So that's a big factor within this all.
Bilal, what does your level head make of the conversation around 50? Does that feel overdone to you for September?
Personally, I think it is a bit overdone. That said, I think that if we were to see a higher unemployment rate today, I think we would go 50 in September. Broadly speaking, I think 25 makes most sense. Also, we do have an election coming up as well. And I think if you go 50 ahead of an election, you do risk getting a certain candidate in the US electoral race upset.
I mean, have you asked your AI model what it expects?
for the Fed in September?
Yes.
Yeah, we haven't quite developed the model to forecast the Fed meeting, but we will next time we speak.
We'll get to that. We've got inflation next week as well, haven't we? So you can factor that into the model's thinking. So if 50 is overdone, if we're looking at 25, I mean, do you characterise what we're seeing in the US then as just still within the realms of soft landing, almost normalisation, rather than anything more epically gloomy? Or do you want to reserve judgment until later this afternoon?
No. I mean, I'd be happy to say now, I don't think we're entering a recession, anytime soon. I do think that there is a slowing of the economy. There is a sort of slowing in level of hiring, but there's no clear evidence that there's massive layoffs occurring in the economy, where even if you look at the Challenger job data, that's not showing big sort of job losses. What we're seeing is decline in companies being willing to hire and an increase in the workforce through undocumented workers, for example. But if you look at, say, GDP in Q2, it was very robust. If you look at personal income, personal spending, it's robust. None of these things are signaling a recession at the moment.
Let me push back on that idea, though, in terms of the kind of slowdown. You're right, the people are slowing their pace of hiring, but isn't that a point of concern itself, given that so many of the companies that were pushing the hiring spree, I'm pointing to your Apples, your Microsofts, your Amazons, et cetera, they're not replacing the workers that are quitting. You fold in the immigration story, which has also been spurring this economy. It may not be a slowdown or a recession right now, but aren't these the early signs of it? I mean, kind of what else do you need to see? Are we just waiting for that moment where we're looking at widespread layoffs? Is that the point we need to get to say, all right, well, that's a recession?
Yeah, it's a great question. And one thing in general I would say is that all the indicators that we typically look at to call a recession have all failed terribly over the last year or two. So ISM's been really weak. We didn't get recession. Yield curve inverted. We didn't get recession. So there's been all sorts of noise in the data. Even the unemployment rate, that it crossed the SARM rule last month, the so-called SARM rule, 0.5% move above the 12-month low. Typically, that gets triggered when you're already in a recession. And there's no evidence that we already are in a recession. So I'd be very cautious. For me, I would think that we need to see a decline in personal income, personal spending. We need to see a decline in household balance sheets values, I think, and there's no evidence that's happening. So when that starts to happen, then I think you have a much stronger case for a recession.
What does that then mean for the range that I'm bringing it right back to the bond market, for the range that the 10-year, the 2-year, if you prefer, will actually trade in? Because it feels like, although we're seeing that move lower, to your point, it could reaccelerate ahead of the U.S. election based on the inflation stats. Give us a floor and a ceiling.
Yeah, I think that in general, I would say that the dynamics of the bond market right now are that it's itching for yields to continue to go down. It just seems like the market just wants it, to push lower and lower and lower. And I think the difficulty right now is if the Fed goes 50, and there, of course, is a chance they go 50, then the market will say, OK, they go 50, we need to start to price other 50s thereafter. So for that reason, I think you could easily see bond yields go down towards, say, 3.5, possibly even. My own view is like...
In the next 2 weeks?
Not necessarily in the next 2 weeks, but in the next, few months or so. In the next few weeks, I think, we could see another 5 to 10 basis points declines in yields. But my base case is I think that a lot of the declines have probably happened, and we'll probably see some stabilization in the next few weeks.
It seems like a lot's resting on the consumer then, if that's the case, Bilal, if the markets are focused on the growth story and all you described there. We spoke to a guest from UBS earlier on today who was talking about how actually we've seen jobs, yes, we're seeing cracks in the labour market, but a lot of people in the US have jobs. The labour market is tight. Wages, real wages, not looking so bad. And so actually expecting some sort of stabilisation on the consumer front. How would you describe the consumer at this point?
Yeah, I would say that the consumer is actually doing relatively well. So if you looked at the Q2 data, consumer, month-on-month, consumer spending was picking up, and the July data also showed it sort of picking up. So just as CapEx is coming off in the US, you're seeing consumer spending picking up. So sort of the growth pattern has been passed on from corporates to the consumer. And I think that's an important trend that we'll probably continue to see in the next few months.
Yeah, on that subject of CapEx, then, that takes us to AI. And, that there's much hope attached to AI in many parts of the market at this point, it would seem. So if CapEx is coming off, does that tell us something worrying about AI and the prospects for AI?
I think it does. I think what this tells us is that the narrative of this AI mania is probably, we're probably past the peak of that, mania. I think last year was the hype. This year's about the reality. How can you use AI? And every company is discovering it's really hard to find true use cases beyond nice little demos. And we're finding at Macro-Hyde, we're using a lot of AI stuff. It's a real grind to kind of find out the real nuggets where it works really, really well. It takes a lot of effort to do that. And I think every company is finding that. And so I think this is a point of realism. And so as a result, I think there'll be a sort of less aggressive sort of push into AI by multiple companies.
Yeah, that's a really interesting observation, isn't it? And it chimes with what we heard from various analysts on Monday that, sank the Nvidia share price 9%, that we need to see this spreading to other parts of the economy. I think it's also interesting that there are some areas that you no doubt there is opportunity in AI, like pharma and drug discovery. Yeah. But when we spoke to Sandoz, I think it was earlier this week, they were saying, well, actually, we use a lot of AI already. So that's another reason to be perhaps a little more cautious about AI expectations.
And there's always the question of monetization, to your point. There's so much CapEx investment at your own firm as well, as you point out. And then we're waiting for it to come back. But I'm wondering if we're waiting for that return on investment, does that catch up to a lot of these companies that might be running out of cash, might be running out of the stimulus, might be running out of the extra issuance that they've been sitting on? At what point do you start to see a liquidity crunch from corporates themselves at a time when we're already seeing the consumer less willing to digest price hikes?
Yeah, absolutely. I think this is going to be a particularly challenging time for corporates, over the next few months. If you look at overall valuations of stocks, they're expecting quite strong earnings growth in the next 12 months. months. And so to realize those earnings is going to be very, very hard. So I think there will be a pullback. There will be many companies starting to scale back or go down, unable to raise the requisite capital to fund that all. The one interesting dimension to this is the larger big tech companies, they're all reiterating that they don't care about profitability. They're going to invest massively in AI and so on. So whether it's Microsoft, Apple, and Amazon. The twist with this one is that normally these companies are independent of each other. They aren't really direct competitors. This is probably the first time in multiple decades that they're going head-to-head. So it's a zero-sum game now. Yeah. One gains, someone else loses. So that's another factor that could see profit margins challenged. So all of this is kind of giving quite a gloomy outlook for the corporate sector.
Well, the luxury that they have and the names that you're talking about is they're sitting on trillions and trillions of cash that they can't deploy in terms of acquisitions or buybacks or whatever that may be. So AI feels like the only correct alternative. Bilal Hafeez, we have to leave it there. Fascinating conversation. CEO and Director of Research over at MacroHive. We talked a lot about the macro. Let's talk about some of the other heavyweights, specifically in this part of the world. Get a quick check on the core 6, because we are seeing a little bit of pressure there. When you look at ASML, down about 0.6%, and on Schneider Electric, also down 0.7%. I go straight there simply because we're talking about that weakness in the tech space, but we're also seeing it in the pharma space as well. Novo Nordisk, a whopping 1.3% decline there as well. Gains, however, in Ferrari, higher by 0.3%. Luxury names, whether it's LVMH, whether it's Puig, seem to be doing quite well today. LVMH, I should say, by comparison, though, it is down 0.4%, but significantly less down than some of its other heavyweights as well. Significantly less down than the rest of the market. So there's got to be a better way to say that. But the point is, Ferrari is in the green, Anna.
You know when you say things and in your head they make perfect sense. But
it all made sense in my head.
I'm sure it did. Kriti with some new language around the markets. Let's get a check on the markets and some individual stocks on the move. Lizzie Burden has a rundown. Lizzie.
Well, I'll try and get my words out, Ada. It's generally a risk-off session across Europe, and for France, it's a risk-off as well. We have had the political gymnastics out of Paris, Michel Barnier as the new Prime Minister, but there's still lots of uncertainty around this. We don't know what sort of compromises he's going to be willing to make with the far right, for example. We haven't heard much out of him since Brexit. So just focusing in on some of these French stocks, all of these banks in the red this morning. But if we turn to the chip stocks as well, they are in negative territory, lots of them, because of the read-through from the Broadcom results last night. This is, of course, the chip supplier to Apple. It fell in late trading after a disappointing sales forecast, and indeed we are seeing a read-through to ASML, ST Micro and Infineon this morning. Just flipping over to the earnings picture, we haven't got Puig trading yet, but Barclays is, and it's in the red. It was up earlier, so fluctuating somewhat, but real estate had been one of the few sectors on the stock 600 to be eking out gains this morning, leading the gains the last time I checked. And it was a stable set of results from Barclays, actually. They said that their full-year pre-tax profit forecast met estimates. And, of course, we've also had Barra and Vistry reporting earlier in the week. Barclays is a little different. It's at the pricier end of the spectrum. And, of course, we've got a new Labour government that's really prioritising home building. It's overhauling the planning system. And actually, Barclays could get hit by the crackdown on non-doms in that October 30th budget. So we keep an eye on that. We also have the macro influence on the home builders this morning. We had the Halifax data saying house prices rose slightly in August thanks to the Bank of England's rate cut, but we will keep an eye on those again throughout the session. And just finally, I've thrown in Darktrace because they had some corporate news this morning. This is, of course, the cybersecurity firm. It's being acquired by private equity firm Thoma Bravo, and it's named Jill Popelka as its new CEO, replacing Poppy Gustafsson. But traders kind of welcomed it earlier. Now Darktrace in the red.
Thanks very much, Lizzie. Lizzie Burden with details on some of those stocks on the move. Coming up on the programme, we'll get back to that chip story. Kriti was just talking through some of the moves on ASML. We've had some new lines coming out at the Dutch. We will get to those shortly. Lizzie was talking about how the sector is responding. The US has slamming China with new export curbs on advanced technologies. This is quantum computing and the like. Find out exactly what they're targeting now in our next conversation. This is Bloomberg.
Welcome back to the opening trade. We're at 22 minutes into the session, and right now we're going to dive right into the chip story because we are seeing ASML and some of the other chip sector stocks take a little bit more of a beating. Remember, the market is down as altogether, but ASML is one of the biggest weights, down by 0.8%. This, of course, comes off the heels of news that the United States is going to be widening what actually is included in those chip exports, and it now looks like you're getting not only Taiwan following the U.S.'s lead, but the Dutch as well. Let's get more insight on this. Bloomberg Daybreak Europe anchor Tom McKenzie joins us now. Tom, let's just simply start with, what do these export controls actually include?
Yeah, and look, it's a reminder that almost on a weekly basis, there's this drip of additional restrictions, or at least planned restrictions from the US and, in some cases, its allies as well. So the latest line is a focus on quantum computing and, as well, equipment in the high-end semiconductor space. And that builds on the restrictions put in place in October of 2022 by the US. These are export controls. They are worldwide. They are global, so they are not particularly targeting and specifically targeting China. But, of course, China will be front and centre in terms of the thinking around this. And the only countries that get exceptions are allies like Japan, like the Netherlands, like the UK as well, who have already, the UK back in April, put in place similar export controls around similar levels of technology. So the US saying, actually, we're playing catch-up on this front to some of our allies in terms of the export controls around quantum computing. The US and China neck and neck in terms of building out these computers that some expect maybe in the next decade could prove remarkably consequential in terms of rewiring the global computing system, and particularly consequential for the world's militaries.
And you mentioned the UK and what it's been doing ahead of this US move. We heard from the Dutch just this morning, the Dutch saying they're aligning their export controls with the US on some ASML machines. So it seems, I don't know how much quantum computing link there is there, but at least the politics seems to be holding strong with the exemptions that you mentioned. There's other chip news as well. Intel said to explore the sale of part of its stake in Mobileye. We seem to get week after week lots of stories about what Intel does next. How does this fit in?
Intel, the stock down 60%, losses in the last quarter of around $1.5 billion US. This is a company facing the biggest crisis in its 56-year history. So absolutely, to your point, we're getting these leaks and details about how Intel may be thinking about restructuring its business and raising funds at this crucial point. So the latest lines, Reuters reporting they have an 88% stake in this US-listed Israeli company, Mobileye. They've already sold down some of it earlier this year. They're considering selling down again. But this is a stock as well that is down around 70% year to date. So how much they can...
And linked to the auto sector.
And linked to the auto sector, which, as we know, faces its own challenges. It's a company that makes software and hardware around autonomous driving. It's facing its own challenges. So how much value they can extract from that is questionable, but it really points to, if not desperation, then the urgency being felt across Intel. Other lines crossing as well, reporting that Qualcomm is looking at eyeing up some of Intel's assets. We know that they're considering, Bloomberg reports, they're considering spinning off even potentially its enterprise business, potentially even its foundry business. Citi, by the way, putting out a note saying that even if they succeed in building out their own foundries, they put that likelihood of success as being minimal, according to Citi.
A lot going on in the chip space. You've got the geopolitics, you've got the restructurings. I mean, to think that Intel and Qualcomm used to be the heart of the global chip industry and in the States, and to lose all that market share globally is a fascinating one. Bloomberg Daybreak Europe anchor Tom McKenzie all over that story for us. Let's talk a little bit about some of the other parts of the market that are trading lower. And, of course, that is going to be putting the French stocks very much in focus. Coming up, we're going to talk about the drivers behind those market moves. The new French premier inheriting a hung parliament and a very fragile economy. We're going to discuss the market's response with Edmond de Rothschild, Marie Jacot next, what she thinks about the read-through of the appointment of Michel Barnier and what that actually means for something like the budget. That conversation next. This is Bloomberg.
I think that the choice of Michel Barnier is a very good one. I know Michel Barnier. I think it's a man who inspires confidence, and including, of course, in Europe, where he was so instrumental.
In the Brexit
negotiation. But difficulties are enormous, including political, but also not only political, also in terms of finance, financial problems and fiscal problems.
Well, he's a fan. Former ECB president and governor of the Bank of France, Jean-Claude Trichet, of course, speaking exclusively to Bloomberg over in Asia overnight, giving us early reaction to the news around the new Prime Minister. So, new Prime Minister Michel Barnier has just weeks to deliver a budget which can withstand a fractured parliament, if that is possible. Speaking just yesterday, he made a plea for unity.
We will act more than talk. We'll try to find solutions coming from everywhere. The government will not pretend to have a superior knowledge. I have learned in my long public life that good ideas come from everywhere, often from the bottom, the most humble of people, when you take the time to listen to them.
So a plea for unity there. Marie Jacot joins us, CEO of Edmond de Rothschild Asset Management France. Marie, excellent that you're able to join us this morning, because there's a lot to talk about when it comes to the French story. You know, Jean-Claude Trichet, clearly a fan of Michel Barnier. He's a very well-known quantity. He's a man with huge experience in France. Many people outside France, certainly here in the UK, feel like they know him very well. We saw a bit of market reaction to his appointment, a little narrowing in spreads if you really look hard for it, but not much. It's going to take more than his appointment, it seems, to narrow spreads against German bonds.
There's been a good reaction so far, but we believe that it's likely that volatility will remain in the market. I think what's the good news is that after considering several candidates like Xavier Bertrand, Bertrand Cazeneuve, Thierry Baudet, President Macron has chosen a Prime Minister who's part of the Republican Party and who is, in theory, not threatened by a censor by the Rassemblement National. But that's a tacit support and leads to a quite fragile political situation in terms of his ability to pass reforms and budget.
I've seen some people comment that perhaps it is Marine Le Pen who will feel a little emboldened by the appointment of Barnier, and you saw Barnier mention immigration and security and things that maybe would appeal to the further right in France. Is that your interpretation, and where does that leave the left and its willingness to cooperate?
It's going to be a subtle game in Parliament. I think, if we take the example of the pension reform, for example, the advantage of that government is that it is in line with the outgoing government, so the likelihood that they are going to try to reverse decisions by President Macron is relatively low. Having said that, the repeal bill by the La France Insoumise could get traction, and it's also possible that the Rassemblement National and Marine Le Pen decide to increase or position their stance as an opposition party and support it. They could, also want to send a message that their tacit support is not an active one and an explicit one, and also show that they're calling the shot in Parliament. So there is a risk of, potentially costly measures to, not be completely avoided.
Put that into some context for us. You mentioned the budget there and the pension reform, of course, bleeding into the budget in terms of the costs, which got Macron into trouble in the first place when this became an issue. We all remember the protests that were hitting Paris and other parts of the country as well. The numbers around the deficit seem to be like a very wide range when you look at it from I think both believe a 5.6% deficit on 2024. We're trying to shoot for, I think Bruno Le Maire at one point promised something close to 5%. We're not getting there anytime soon, no matter who you ask, the IMF, the French government themselves. What do we need to see for that budget to be more digestible for the EU?
So, first of all, as you said earlier, they're going to have barely 2 weeks to come up with measures. And the issue is that, fiscal policies and decisions have clearly not been at the heart of President Macron's consultations in the recent past. So the government is really going to have to work under huge time pressure. And we know, because of Michel Barnier being from the Republican Party, that they're in theory going to avoid increasing revenues through increasing taxes, but we don't know that for sure, and it's at this point of time very difficult to say what sort of measures they are going to to come up with. But one thing is sure is that it's the absolute priority for this government, and they have very little time to implement. So what it means is that he's going to be able to get anything done. He's going to have to, at the bare minimum, get the abstention from some of the non-affiliated deputies or LIOT, for example, if not the active support from some of the extreme right deputies in Parliament. Otherwise, he's going to have to use the 49.3 over and over again, and then he risks a vote of no confidence, and then, nothing is going to get done, really.
So it all seems like a very scary and a very kind of frustrating and intense situation that doesn't necessarily yield positive results given the time crunch. But on the positive side, if I may inject some happiness here, is that Michel Barnier is a skilled diplomat. He is a skilled negotiator. So I think the logic from some has been that he can actually manage the division that you're seeing in Parliament. The other side of it is that from the EU side, there may actually be concessions to the French government if this deficit doesn't quite match their standards. Does that change your view on France and the investability of France, given the cushion that they may get from the EU and given the global confidence that perhaps is growing in this pick?
That would certainly be helpful. And when you look at how the markets have reacted so far, and French equities, for example, you see that the French stocks that were purely domestic ones have actually already recovered from the losses from the snap election time. And we have to remember that 85% of the MSCI France and the CAC is actually, driven by stocks that are, global stocks and have a global exposure. So I think that's, their volatility and the way they behave is actually quite independent from French politics. Our position at the moment is that we've taken profits from European equities and we're neutral. We're more interested in emerging markets, in the equity space, but also in the credit space. And that's really because of, the recent announcement of the easing policy by the Fed. And we believe that it will, help get flows into emerging markets who have actually weathered the inflation crisis pretty well. So we're quite excited about, that part and that region, if I may say, of equities.
So
Europe.
So your interest is elsewhere, and is that because you think that there are risks that we just do all this again in a year? We go into further parliamentary elections in a year or so, Marie. Is that one of the reasons why you look elsewhere? Because we could see volatility or even negativity attached to politics in Europe.
It's one of the reasons, definitely. And if we go from, vote of no confidence that the government doesn't survive, then, it's very likely that it will happen. But I think the other argument is independent of this, and it's really linked to the worries around European growth. And more generally, when you look at growth in developed markets, recent year and then expected for the years to come, it's more around, 1.6, 1.8%, where you look at, emerging markets, you're around 4%. So the risk of recession is also lower in emerging markets than developed markets at the moment.
I want to bring it right back to kind of the French politics here in terms of how, maybe not the Barnier pick, but how Macron moves forward in terms of other policy decisions that are more oriented to things like the risk in China when it comes to EV, when it comes to fiscal spend in manufacturing, or even in services where right now French credit, to your point, is being compared to the likes of Spain and Italy and underperforming the periphery, which I'm sure a lot of French people aren't super thrilled about. But walk us through the reaction, not just to some of the other global pressures in China, but also in the United States. Macron has been very vocal about something like the IRA, for example, disincentivizing investment in France. Does this change, does the developments in France change their outlook to the rest of the world?
I don't, long term, I don't believe so. I think there was, some of the reaction was short-term reaction. I think there is a true interest in, globalization, global interest, global investments that hasn't changed. And I don't think we can afford to change it, quite frankly. And certainly when we look at investors in France, in Europe in general, they have that, global view and outreach. And I don't believe that it is going to change anytime soon. I think you mentioned the French credit, and it's absolutely true. I think global markets have actually decoupled from French risks, which makes them actually not as attractive as they used to be for the time being. But with time, we believe that although we're going to have volatility for an amount of time, things are going to get in place.
We know that Michel Barnier has a lot of experience dealing with Brussels, operating in Brussels, and we've already talked about how that might help in the sense of the French budget and maybe getting some favourable treatment there, or at least a willing ear to listen. What does this tell us about the role of France in Europe? Because Germany's busy being distracted by domestic politics as well, and so with the two heavyweights of Europe both distracted by domestic politics, I mean, does this give more power perhaps to France within Europe? The fact that they've appointed somebody with such strong European Brussels credentials to the role of Prime Minister?
Hopefully. We'll see. But the Michel Barnier's profile and curriculum, surely, he's a convinced European. And in the recent context, it's obviously a very good news for Europe and Germany, I would say. And we can only hope that it's going to create a better momentum in general for Europe, not necessarily for France's role in Europe, but we certainly believe that both France and Germany have to be strong for the European project to work, not only France.
OK, Marie, thank you so much for joining us. Really nice to see you this morning. Marie Jacot, CEO of Edmond de Rothschild Asset Management France, bringing to a close a week where day after day we were waiting for news around the French Prime Minister, and finally that came yesterday. Markets have responded for the moment, at least. Coming up on the programme, we'll talk US politics. Donald Trump unveils his economic agenda, including a role for Elon Musk. All the details next. This is Bloomberg.
I am promising low taxes, low regulations, low energy costs, low interest rates, secure borders, low crime, and surging incomes for citizens of every race, religion, color, and creed.
Donald Trump pitching his economic agenda to Wall Street and corporate leaders in New York. I want to dive right into the details here. There's so much to unpack. Bloomberg senior writer Stephanie Baker, who, of course, keeps an eye on U.S. politics, joins us around the table this morning. Stephanie, this one's a fascinating one for me because the economy did so well under President Trump. He represents a right-wing, I shouldn't say right-wing, but like a right-leaning party. Of course, the Republicans, the markets do better historically under Republican leadership as well. They're more market-friendly policies. This time around, there's a lot of hesitation about whether or not a Trump 2.0 would be friendly to the markets, to the business community, to the economy. What do you make of that?
Well, my big takeaway from his speech last night, and I think people aren't focusing on it enough, is his proposals to impose these sweeping tariffs, which it's part of what I think is his incoherent economic agenda. He's proposing to do all these things that don't make sense when you put it all together. Most economists, mainstream economists, will say that if you impose these sweeping tariffs on all foreign goods, 10 to 20%, as he's proposed, would cause inflation. And that goes against what he's saying he's going to do, which is, lower costs for consumers, keep interest rates low. And it risks setting off a global trade war. I don't think people are appreciating how big of a deal it is. The other thing is a lot of his proposals are not costed. he wants to extend the 2017 tax cuts at a cost of something like $4.6 trillion. Various other proposals that he has not spelled out how he's going to pay for them. It sounds great, right? We all want lower gas prices. We want lower taxes. But how are you going to pay for it? And I think that is perhaps spooking the markets.
Stephanie, what do you get a sense that American voters will be voting on? Because we, of course, talk about the policies and the economics, and we try and, get to the nuts and bolts of market expectations. I was looking at Nomura's expectations that, under Trump, inflation goes higher, the deficit higher, but also maybe GDP higher. Do voters think about that stuff when they go to the polls, or are they thinking about, they've experience of Trump already to reflect on. What sense do you get as to what they'll be voting on early November?
Obviously, pocketbook issues, inflation, the costs have risen so much since the pandemic, and voters are blaming Biden for that. Even though he has managed to bring inflation down, he's managed that soft landing, in a way that no one thought was possible, brought inflation down more quickly than in Europe. The economy is growing stronger. Biden hasn't gotten credit for that. Everyone remembers the pre-COVID times with Trump when prices were lower. And I think the challenge here is that Trump is still more trusted on the economy than Kamala Harris is. What she has to do and what she's trying to do is present him as, just cutting taxes for wealthy people, and that she is the candidate that's going to really deliver for the middle class and help with, real life issues like child care costs. And that was one of the things that he said last night that was completely incoherent, rambling answer on child care, made no sense.
And he did spend quite a bit of time, Kriti, talking about Kamala Harris and what she has to offer.
He did. In fact, we should just go to that sound right now in terms of the criticisms, how he and a lot of his following is interpreting her policies. Take a listen.
She's promising communist price controls, wealth confiscation, energy annihilation, reparations, the largest tax increase ever imposed, and mass amnesty and citizenship for tens of millions of migrants who will consume trillions of dollars in federal benefits and destroy Social Security and Medicare. They will be destroyed.
So some strong words there coming from President Trump, unsurprisingly, on the vague idea of Kamala Harris's economic agenda. But he's not alone in this. Economists have also said that the price gouging that she's trying to address could hurt the economy as well. So she's not clear from this, especially because we have the example of the 70s, where I think Nixon tried to do this and actually end up backfiring on him. Do either one of these candidates actually have a plan that's going to help the U.S. economy, or are we only talking risks here?
Well, he made a number of misleading statements and outright falsehoods there. I mean, he's accused her of supporting the banning of fracking, for instance, in Pennsylvania, which she has said that she no longer supports. She did support that in 2019. It's true that Harris's economic agenda is still quite vague, but so is Trump's. Some of the tax proposals that he proposed yesterday, including lower corporate taxes for manufacturers if they produce in the U.S., it's unclear what that means. What is the definition of made in America? So I think Harris will be under pressure to outline more details of her economic vision. That price gouging proposal is quite vague. How is it really going to work in practice? And I think she'll be under the gun at the debate on Tuesday to really articulate more details on that and what her vision is. Obviously, the difference between the two is she's raising taxes, albeit less than what Biden had proposed, and he's proposing to cut taxes, but the gap of how he's going to pay for it is huge.
The Made in America piece that you bring up is one that Anna's been pointing all morning to, which is that the thing that is Made in America brand, is it assembled in the U.S. or is it?
I mean, define it how you will. I'm not sure if that detail is available to us yet.
But this is an issue that comes in terms of GDP counting as well from the economic bureaus as well.
Yes, right. So that's the politics. And Stephanie, thank you very much for the update there, Bloomberg. Stephanie Baker with that. So what does this mean for markets if we were to see a Trump 2.0? Bloomberg EMEA FX and Rates Managing Editor Rachel Evans with us has been thinking about this, of course, from a market's perspective. Give us an update on Trump's latest stance on the dollar and how his stance on the dollar fits with what he's trying to do on tariffs.
Yeah, it's all a little bit disjointed. But I mean, he's come out through the course of the campaign and talked about wanting to favour a weaker dollar, sort of discarding the strong dollar policy that sort of marked kind of the administrations of the last sort of 20 years or so, to kind of try and sort of make America more competitive in that respect by having a sort of weaker currency. The tricky bit with that is that some of his other policies that he's outlined would, all else equal, boost the dollar. So we're thinking about, if you do have, for example, corporate tax being lowered to 15%, as he's been talking about most recently, that, obviously isn't necessarily something that is going to be good from a income perspective for the US government. You are likely to see the deficit rising as a result of lower tax, and that should, all else equal, keep the dollar stronger. You might see kind of the Federal Reserve being able to cut less aggressively, something that would weaken the dollar because they need to kind of basically keep rates high to cut down on some of the inflationary pressures that policies like tariffs would potentially encourage. Yeah. And then when you look at tariffs themselves, if you're hitting China or Mexico, again, those are things that are likely to kind of keep the dollar strong. Yeah. So some of this is a little bit.
You're right to keep pointing us back to all else being equal, Rachel, because, we do our best to draw conclusions about Trump's past presidency, but then COVID happened. Yeah. Nobody saw that coming, and that then led into Biden and what we saw around inflation there. So, we can't include those things because they are unforeseeable, but we do our best in the meantime.
Not to mention the fiscal spend that has come since from the Biden administration. But, Rachel, I want to come back to you in terms of, you talk about this kind of bullish dollar narrative. We were just talking to Paul Dobson in the last hour, who was talking about how positioning right now is very weak dollar. And how does that square? Is that just setting us up for a massive dislocation in the last quarter of the year?
Potentially, yeah. I mean, I think obviously in the last sort of 2 months or so, we've started to see a much weaker dollar as everybody kind of gets ready for Fed cuts. And we did see sort of positioning amongst hedge funds and other speculative traders flipping from being sort of bullish to being bearish the dollar. It makes sense. The macro sort of backdrop is very much leaning towards those kind of aggressive Fed cuts. And that's ultimately what really is kind of driving markets at the moment. The politics is kind of a cross current that creates a bit of noise from time to time. But yeah, if we do see kind of a Trump presidency coming in, that could potentially prompt a lot of a rethink about the path of the Fed and the path of the dollar.
So that's the politics. We wait for November to get clarity on that. In the meantime, we're waiting for a jobs report, Rachel. We've got US futures pointing downwards increasingly, actually. Nasdaq futures down by just over 1% now. I know your focus is on other assets, but this risk aversion into the jobs report, often on days like this, we talk about people sitting on their hands until we see the data. Is this unusual?
I think people are taking a little bit of money, maybe out of the markets until they see some clarity. There is a lot riding on this print. We talk about like the Fed being about to cut. That's obviously the bigger picture view, but we're really talking about how aggressively they cut. And the bond market in particular is quite torn on whether we're going to see, your standard 25 basis point cut in September, or whether we could see that jumbo 50 basis points to kick things off. That would be very unusual and would sort of suggest that the Fed really does kind of see the economy deteriorating quite rapidly. At the moment, the market is pricing sort of about 30% chance of that 50 basis point cut in September, and then about 110 basis points through the end of the year. So that's just at least 150 basis point cut. So people are looking to this jobs report to really kind of decide whether it is going to be 50 or 25.
OK, and that seems more important than CPI next week now, doesn't it, given what we recently heard from the Fed at Jackson Hole. Rachel Evans, thank you, Bloomberg's Rachel Evans. So a lot riding today, Kriti, on this jobs report.
152,000 is the whisper number. 162,000 is the survey number. We'll see what happens. We might be more excited today about the jobs report. I bet you on Monday it'll be all about the CPI. That does it for the opening trade. The Pulse is up next. An all-star lineup. Stick with us. This is Bloomberg.